Yo, my name is Sebastian Salvela. So the only reason you invest in anything is so that you can make more money. So you analyze the investment opportunity and the returns that you can make. So you look at past returns, the market that it's in, and current financial numbers, and you make an educated guess about what type of return the investment is going to make you in the future. So what you're buying every time you invest are future streams of income. So you pay now for the income the business is going to provide you later. And real estate is no different. So in this video, I'm going to talk about all the different ways you can make money if you invest in an investment property. So I've touched on this topic briefly before, but this time I'm going to go a little bit deeper so that you guys can get a better understanding of how money is really made in real estate. So there's 4 basic returns: cash flow, appreciation, amortization, and tax benefits. Just like the name suggests, cash flow represents the flow of money. Over a period of time, maybe monthly or annually, you compare how much money is flowing in versus how much money is flowing out. So the net difference between the two can either be positive or negative. So a simple example of that is looking at your own bank account. So you have income flowing in from your job and you have expenses flowing out from paying your bills and whatever else you spend money on. So at the end of the month, if you have any money left over, that's positive cash flow, and you could either save or invest that money. If your expenses are more than your income, that's negative cash flow, and you may have to pull money from your savings or accrue more debt by borrowing money to just stay current on all your bills. It works the same way in real estate. You have money coming in from rent, and you have money going out from operating the property and paying your mortgage. I'll make a different video breaking down income and expenses for an investment property in more details in the future. So make sure you subscribe if you want to see that. But obviously, it's ideal for any investment to have a positive cash flow. After paying all your bills, you want to have enough money left over that can accumulate over time. You could then use that money to either save as cash reserves or make improvements on your property or help you buy more properties. When the cash flow from all your different properties become large enough, it could help you reach financial independence. Now, appreciation is when properties go up in value. If you bought a property in 2010 for $300,000 and it's now worth $400,000, then your property appreciated in value by $100,000. Now, if you decided to sell now, you would have made $100,000 by doing nothing else but just living there. But property values don't always go up. The real estate market, just like the stock market and other markets, can be volatile and has cycles where property values go up and down. Now, the term bull market is used when the economy is doing well and employment is high. So during a bull market, people tend to buy more and feel more comfortable spending more money. Property values go up because the demand for homes is high. The term bear market is used when the economy is not doing well. People are uncertain about their job stability, so they spend less. More people suffer from unemployment, which stops spending altogether. So the value of properties go down because no one is willing to spend that kind of money on a new home and risk on taking more debt. Depending on where you live, your city might be affected more than others in either a bull or bear market. But when you're looking at property values for an extended period of time, they generally go up. Some markets appreciate slowly and some a lot quicker. But if you buy a property in any market and can hold on to it long enough, then you'll be able to sell it for more than you bought it for. The third way to make money on an investment property is amortization. So when you buy a property, most people typically pay a percentage of the full price and borrow the rest. So if a property costs $100,000, you might not have all that money sitting in your bank account. Even if you did, you might not want to deplete all your savings on that one property. So what most people typically do is put a down payment, so pay a percentage of that full cost, so 5 to 20% down, and then they finance the rest with a lender. Let's say in this example, you put 20% down and finance the rest. You now have a mortgage payment every month until you pay the loan back in full over the term of the loan, and sometimes even longer. Now, as you already know, a portion of that mortgage is interest, which is how the lender makes money. The other portion goes towards the principal balance, and that portion is the amortization. So every time you make a mortgage payment, you gain a little bit more equity in the property. I feel like people overlook this type of income when talking about investment properties because it's not liquid. But when you consider that a tenant is paying your mortgage every month, you're essentially using somebody else's money to build your equity and your net worth. And I think that's a powerful concept. Last but not least, tax benefits. Our four biggest expenses are taxes, housing, transportation, and food. So anytime you could significantly reduce any of those costs, you could substantially increase the amount of money you have left to save and invest. So not only having an investment property could help you reduce the amount that you pay on housing if you house hack, it could also help you reduce the amount of taxes you pay on your income from your investment property. So any cost associated with operating the property is tax deductible. So things like property tax and insurance, small repairs that you do in a home, utilities, and property manager fees if you have one. Now, even the interest that you pay on the loan, even though it's not an operating expense, is also tax deductible. But that's not all. So even though your property might be going up in value, the roof, the foundation, the plumbing, the electrical are all getting older. So your property is seen as a depreciable asset. So for residential properties, the IRS allows you to deduct the value of the physical building, so not the land, over 27 and a half years. Depreciation can get a little bit confusing, so I'll probably make a separate video about that too in the future. So don't forget to subscribe. But with all these tax breaks, you could dramatically reduce the amount of money that you pay in taxes and have more money left in your pocket. So those are all the different ways you can make money with an investment property. It's important not to just consider the monthly cash flow and the appreciation of the property. You must also consider the equity that you're gaining every month and all the tax breaks that you don't get if you're just leasing. Even though I like to invest in the stock market because of how passive it could be, you could still only make money two ways, and that's from dividends and from the value of the stocks going up. But you have no control over any of it. In real estate, you have more control over what you could actually do with the property, with the improvements that you could make to increase your returns on investment. Improvements can help you charge more in rent every month, which increases cash flow. Improvements can also increase the overall value of the property, even beyond the amount of money that you spend for these improvements. Investing in an investment property could feel a little bit scary because of all the money that you need up front. But the long-term potential and opportunities for income are huge, and in my opinion are worth the risk if you have the means. There you have it. That's all I got for today. If you think this video was helpful, subscribe to my channel and don't forget to like, comment, or share with a family or friend that you think might be interested in that type of content. Thank you guys so much for watching, and I'll see you next time. Peace!